Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich. Today's topic is on the Great Rotation. That's right. We're going to talk about the Great Rotation. This can be thought of as an investment strategy that for the short term, it could benefit in the short term and also in the longer term. Think over the next 2 to 5 years, right? So we have the combination of a short-term trade that could turn into a long-term trade. Boy, if that combination doesn't tickle your pickle, I don't know what will. Now, last week we talked about the merits of the utility sector. This doesn't change any of that, right? If you think the equity rally's gotten long in the tooth, then you want to think about the defensive utility sector, right? Because it still has a lot of positive merits to it. But what I want to talk about today is suppose the equity rally continues. Who would be likely to benefit most, right? If the Fed keeps pumping in liquidity, if the recovery continues, if this Goldilocks environment continues, who would benefit most? Industrials, right? That's the idea of the Great Rotation. The idea is that at some point, we had to shift from the tech sector into the cyclical sector. Right? Shift from tech into the cyclical sectors. And the biggest benefactor would likely be industrials when that great rotation happens. Okay, so I think we're starting to see signs of it right now. Let me explain that. Here, we just have performance for the past week. Here we have the industrial sector top performer on the week, up 3.1%. On the month, top performer up 8. Up 8. Right, that's huge. Look at the difference here. It's up 8. Now look, on a year-to-date basis, come down here to the bottom. The industrials overall are still down 5. They're down 5. The S&P's up about 4.5. NASDAQ's up about 23. Industrials are still down 5. Wow, that tells the fat man that looks like they still have some room to run there, huh? They still have some room to run. But is that a horse we want to ride? Well, let's start off by looking at the earnings profile. What does it look like? So here we're looking at monthly earnings numbers. These are EBITDA numbers for the entire industrial sector. All right. So each stick here is a monthly observation. And you can see we just recently started to turn over. All right. It was very gradual until this most recent month. But the thing you have to remember about this is that we're in an earnings down cycle. Right? Damn near everything, all 11, or most of the 11 sectors in the U.S. are in an earnings down cycle. Industrials are holding up much better than a lot of the other ones. Is it holding up better than tech? No. I'm not going to try to sell you that bullshit because it's not true. Tech is holding up better. But here's the key. Is it priced in? Right? The tech earnings profile is priced in. Hell, I would go as far as to argue it's overpriced in. You got PE ratios in tech like 35. I mean, it's just nuts. What about industrials? Well, one way to look at this is on the cross price here. All right. Some people call them price relatives. I call them a cross price. All right. So this is just a price each day of the industrial S&P 500 sector divided by the broad basket in total. Okay, so we start here at 1, and where are we at today? Well, we're way down here, okay? So very recently, industrials were at their cheapest level in the last 20 years. Oh, shit. Let's stop. Clean your ears out here. Let's try that again. Industrials were trading cheaper than they did during the '08 Great Recession. Right? The '08 crash. They were trading cheaper than the 2001 recession, and we're just coming off those bottoms. In fact, that's why I wanted to wait for some signs of recovery before getting excited about this. You can see it has been bouncing around down here for quite some time. So instead of catching a falling knife like you would do, say, with the energy sector, that would be the next one, the next cyclical you might want to think about. And instead of doing that, you want to wait for some signs of recovery. All right. So would it have been nice to get in before it appreciated 8% a month ago? Yeah, of course it would have. But then you would have been catching a falling knife. All right. This is a different play here. So let's pull these things together here. On a short-term basis, again, you've got the tailwind of chasing an ambulance, right? You are chasing the top performing sector right now. Okay. Right. You also have the possibility that there will be a jobs bill, right? A jobs bill that is passed, an infrastructure bill that would be passed as a form of a jobs bill, right? That also gives some attractiveness to this idea. And remember, the great rotation, at some point, tech is not going to be the only beneficiary of this digital super cycle. At some point, we are going to rotate out of tech into some other cyclical areas. And that's where we want to think about industrials. Okay, so how do we play this? If we get excited, we don't want to miss a great rotation. How do we play this? Well, you could just look at the passive basket, right? The passive ETF, it's very liquid. It's called the XLI, right? You can buy the entire cap-weighted industrial sector, right? It's cheap, it's liquid, right? It's called the XLI. Now, other than that, you could play individual names, right? These are names, household names. You all know these household names, right? We're talking about UPS, Union Pacific, 3M, Caterpillar, Honeywell, John Deere, yada, 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 right? The list goes on. These are all highly liquid names. You might want to, think about differentiating between these highly liquid names, the ones you're more comfortable with, ones you're more familiar with, or just using the entire basket there, the XLI. Either way, that would work out, should work out quite nice for you. Again, there's a possibility of a twofer on this one. It looks good from a short-term perspective, and it looks good from a long-term perspective. Okay, so that's our message for today. I hope you enjoyed it. If you did, hey, help a fat guy out, okay? Go to my YouTube channel, Rich Insights, and subscribe. All right, hey, try to help a fat guy out here if you can. Okay, so our message today is, if you don't want to miss the great rotation and you think we're at the start of it, you want to be thinking about industrials. Okay, so I'm Don Rich, and you've just experienced a Rich Insight. May your beer be colder than the company you keep. We'll talk again soon. Thank you.